Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's October 31st. Happy Halloween. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down headlines and tell you what's really moving these markets. So, literally just got off my plane. I say just got off about 10 hours ago in San Francisco, the Cambridge Gold and Silver Summit. I spoke several times on several panels, some pretty amazing analysts, a lot of fun. On panels with Rick Rule, Doug Casey, Marika Tusa, Mike Williams. Had meetings in between, tons of them. Great conversations, and some of the top people in the industry, including a really cool one with Rob McEwen, who founded Goldcorp. He's now the chairman and CEO of McEwen Mining. Interviewed him once before on the podcast. Going to break down the conference, that meeting with McEwen Mining. Also, share some interesting ideas with you later in my educational segment. But right now, I want to talk to you about something that's much more important, super important. And that's San Francisco, where this conference took place. And when you ask people about San Francisco, it's one of those places, the response you get, either they love it or hate it. It's never like in the middle, it's okay. Oh, I love it. It's the best place ever. Oh, I hate San Francisco. I have to tell you, from being there so many, I wouldn't say so many times, but a half dozen times, a little bit more, maybe close to a dozen. I have to say, I may be leaning towards the hate part of San Francisco. And I have a lot of friends there. I'm not talking about you. I'm just talking about in general, right? From someone who travels the world, what I like to do is to get out and talk to people, hang out, local communities. And it's always fun just talking to people. It's just learning. Hey, what do you do? What's going on? How's business? When it comes to San Francisco, I think it's one of the most rudest places. Like, people just don't want to talk to you. And it's okay if you're not social. It's fine. It's all right. Not a problem. But for me, it may be my experiences, but I hear this from a lot of people as well. There's very little interaction. Nobody wants to look up. There's no eye contact. Nobody wants to talk to you. They're doing their thing. Maybe they're just so busy, right? Everybody's busy these days. And again, I get that's fine. I'm walking around certain areas and I asked for directions twice. And both of those people gave me wrong directions. I don't look like a terrible guy, right? I was in my suit, and it was like 2 blocks away from where I had to be, and they were just, it was like they pointed. They just pointed, and it was like, that way. But he didn't want to talk to me, and it turned out to be the wrong way. Again, it was just like I walked a half a block or a block, and then I finally realized it. But it was like, I don't know if it was on purpose or whatever, but it seems every time I go there, it's so hard to talk to people. It's just not a friendly environment. I don't get it. Maybe just me again. I don't want to get millions of emails. Crazy. I get it. I wanted to dial down a little bit because every minute since I got off the flight on Saturday was busy. So just really crazy. Just meetings. Every minute accounted for. Had a big speech, which I talked about our security token, Curzio equity owners. We plan on launching in about a month. Went very well. A lot of people are interested in it, but I was really dialed in. Again, lots of speaking engagements. Even when I wasn't speaking, I think it was 3 times the first day, 3 times the second time, bunch of meetings, panel, just had meetings in between as well. Just crazy. So last night I was like, look, I just need to have some beers, listen to music, hang out with close friends. And we ended up at this bar, probably about 20 of us. There's a bunch of great people from Cambridge that work their butts off, right? Everybody's just extremely busy. Now the conference ended. I'm, leaving like 11 o'clock, 10 o'clock the next day. It was a go out for a little bit. But they joined us. It was, just CEOs, again, who had just busy schedule. We all went out together. It was just, really cool. Nice night. And in San Francisco, everything closes at 2 a.m. By everything, I mean every single bar. And when it closed, nobody serves alcohol. That's it. No way, nothing. It's kind of crazy. And that's 2 a.m. It's not like New York where you could drink till 4 a.m. Not like, I was always out then. Maybe when I was younger, of course. But even New York, you can always find after-hour places. Just ask anybody at bar. They're nothing. It's almost like, you serve alcohol. I mean, it's like you go to jail for life, right? That's how they treat. No, we can't. Like, it's crazy. So anyway, it was like 10 to 2. So we had like 10 minutes left, and we all ended up at this really nice bar, really cool, laid back, pretty crowded, not just at the bar. And all of a sudden, this guy comes in. He's got this beard. It looked like he just came off the street and just starts yelling. He's going up and down. It turned out it was the owner. It was the owner of this bar yelling, saying, "Get the F out of my bar. It's closed now. I'm not effing joking. Get out. Take those beers." Like they were taking like half beers away from people. I mean, I don't think I've ever seen that ever. I mean, it's the last 10 minutes. As soon as you say last call, what do people do? Get at least 1-2 beers, drink them really quick. They want to go. Yeah, it's last call. No, not they just start yelling at everybody. Everyone's like it's having a good time, relaxing, yelling up and down, going crazy. And I know you don't see that every place, but it just amazed me. And we're spending money here. Just all right, we had stuff 10 minutes. Not that you have to close it too. You have to yell and curse at everybody. It was just insane. So everyone's leaving. And again, when I said 2:00, everything closes. I'm talking about convenience stores, hotels, Uber Eats, diners. The reason why I know all that is because everybody's going through different options to try to get alcohol, I guess. So, but just crazy. Yelling at your customers. Really? I mean, do you need to be such an asshole? I mean, I don't get it. And maybe everyone's so pissed there, at least the people I talk about, because look, taxes, you get raised like it seems like every couple of months, right? Whether it's gasoline, home, income, whatever. I know there you can say, well, it's good. You're taking more money from rich people, and those are people who are getting their taxes raised. But that's in San Francisco. We're talking about what? People who make $250,000 a year, which is nothing in San Francisco. Nothing. You can't live on that in that area. There's a reason why 60% of the workers in Silicon Valley, they actually said they can't afford to live there. And technology is, if not the most booming, but biggest booming sector. And yes, I know these stocks came down 15% each and FANG and stuff like that in technology. They're still up tens of thousands % over the past couple of years. Some of those stocks anyway. Despite paying those high taxes in the nation. I get it. You pay all these high taxes, but you still have a massive budget deficit, right? That everybody complains about since politicians are never going to stop spending ever. I do find it kind of ironic that you complain about that since San Francisco is a liberal town. We all know it. For more equality. But a lot of you complain when your taxes are raised, which are what? To supposedly support or filter down in terms of benefits to less unfortunate people who refuse to get a job because they're getting lots of benefits in an economy where it may be the most job-friendly since the history of our nation. I won't go there. I won't rant anymore. But I'm still trying to figure out San Francisco. Again, it could be me. I'm probably going to get a lot of emails because people love it or they hate it. And the people that love it are going to be afraid you're crazy. And it's a beautiful town. But I'm just talking about the people. It's just not as friendly. And it should be friendly, right? It's filled with young millennials, entrepreneurs, just great kids. I mean, that should be an environment you want to hang out with, right? Well, hang out, be part of. It's weird that it's not for me. That's just based on my experience. And then when it comes to politics, whoa. Hate Trump Central. I would love to see someone wear Make America Great Again hat. Imagine wearing that. You would get beat up. I don't know if you get beat up. There's a lot of skinny people there. Everyone's in shape in San Francisco. I don't know if they'll, yeah. But anyway, they'll throw things at you and yell at you. Maybe say it that way. But even some of the conversations that I have, the younger generation, and we had an amazing dinner before we went out with just a group of people, and this was Monday night. Amazing people. I mean, 2 young people from a company that we're doing our STO through, doing a platform, which is just brilliant kids, entrepreneurs, and Doug Casey was there. So it's like the old guard, new guard type thing. And politics came up. And even the person who brought it up said, listen, I just want to hear your thoughts. No fighting, no nothing. And it was really cool, actually, to have a conversation where you don't hate each other and just show, what's going on and what you like and what you don't like. Because you don't see that these days, right? If you're one side, you hate the other side automatically, no matter what, even if it's a good idea, whatever it is. We all know it. But there's a clear hate for Trump by the younger generation, especially there. And when I say hate, which is, again, you don't like the other, whatever it is, but it's like, I hope he dies tomorrow type hate, where it's his fault for, the terrible shootings in Pittsburgh, the inequality among Afro-Americans. It's his fault women don't have equal, it's almost like you're pointing to someone that no matter what happens, it's his fault. And again, we know he tweets, we know how stupid things he says. Again, we all know that, we all see it, but I'm just, it's not like, man, that guy's such an idiot. It's, wow, I hope he kind of like, it's crazy. It's nuts. I don't know. Maybe it's me. I mean, I'm not sure. Maybe I wasn't looking hard enough when I was younger, where I don't remember seeing that type of hate with President Obama, President Bush, President Clinton. Maybe it was there. I don't know. Maybe I just wasn't looking hard enough. You didn't agree with their policies. It wasn't like, man, I hope this guy gets run over. It's insane. Like, it's just the anger. I'm talking about the outside the diehards and extremists, of course. You're always going to have those. I'm just talking about even guys that are kind of like normal, like, oh man, I don't like, if you're a Democrat and I don't like, Bush's policies, or Obama, man, I don't like these policies. Like me, I didn't like certain policies with Obama because, it just affected me with business. I'm paying more healthcare costs than ever. I work 16, 17 hours a day, really, really hard. And I hate the fact that people say, well, you should give a little more when I'm taking time away from my kids, trying to give them a better life. And I know that if deep down, if you really wanted a job in this economy, you could have it. But there's other policies that I agree with. It wasn't that I hate anything or anything like that, but you can't talk like this. You can't really talk and have a decent conversation about it, which is insane. Even now, I'm sure people listening to this going, Frank, I wish you didn't talk about politics. But it was a big topic. And it's important, guys, that we do talk about this, because I got to tell you, this is the number one biggest risk to your portfolios. I don't care what side of the aisle you're on right now. That's why I'm talking about it. That's how crazy it is. You say, well, there's so many risks to the marketplace. Yeah, they are. There are tons of risks to the marketplace. What is that? The Fed. You have tariffs, rising dollar, things like that. But those things, I mean, you could have, Trump and Xi Jinping, if I said that right, the president of China. I mean, they could have a couple beers together, get drunk, and just decide to figure this out, and we're good. We could have Powell come in and say, hey, you know what? Okay, we're going to take a little slower pace. We're not going to raise rates no matter what. Things like that could easily reverse, and you could see things get better. But when it comes to the politics and the hate, it's going to get worse, 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 which is terrible. So I got to tell you, when the Democrats take a lot of seats and are going to take control of the House, most likely, right? 80% chance. Based on most of the polls out there, we saw what happened. Again, polls are polls. We saw it the last election. But what's going to happen? Because if you look at our political system, it's supposed to be the greatest environment when we have bipartisan control, which is not one party controlling everything, House, Senate, and President. It's usually better because you have accountability and saying, whoa, don't do that. Okay. It's usually that's where our economy grows the most, but just the economic landscape is usually the best during those conditions. And when that happens, there's so much hate that you can see nothing ever getting done, ever. And that's really bad, especially when it comes to things like infrastructure, right? Which both parties agreed on. And think about that. They both agreed on $1 trillion infrastructure package, even though we know our bridges, dams, water systems are super old and could cause people to actually die. They're not going to come together on even something this important that will protect Americans, and that I believe almost every person in America is for, which is a much safer environment for our kids and our kids, right? We all want that, right? But you really won't come together to do something that's better for the nation and better for the health and safety for us just because you hate each other. And again, this is dangerous for the markets. Truly believe this is the biggest risk on the table, which you should be worried about. Everything else, again, but with the Fed, we can just reverse course. I mean, you've seen our bills much higher, no matter what bill, your cable, electric, phone, food, tuition, and going higher. Maybe the Fed said, okay, we got inflation now. Wages even going high. Okay, well, slow down, whatever. Or again, China and U.S. figure this thing out. There's a million things you can do behind the scenes to figure this thing out. That's fine. And those risks are reversible. They can ease. But politically, that's a huge risk. And I don't know if that's priced into the markets. I have to tell you, if you don't think political risk is a big deal, you're definitely going to think differently after this interview, which is with Lenore Hawkins. I interviewed for the first time, I want to say about 5 months ago, around there. Got an amazing response because she's great. She's awesome. She's chief macro strategist for Tematica Research, 20 years of experience covering the markets. And you know what? She's in Italy right now. She's talking to her sources, getting that boots on the ground perspective for her followers. And you know as well as I do, when we read stories in America about other places out there, we only know what we read because it's hard to get a boots on the ground approach in other countries especially, not just in other industries and companies. And I'm a good case for that when I went to Brazil for the World Cup. I mean, I thought there was going to be body parts floating in the water. I'm going to get, the crap kicked out of me as soon as if I walked around at night. No, it was a beautiful place. It was awesome. It was nice. I loved it. It was great. I couldn't believe some of the stuff I read. But with Italy, man, interest rates rising, economy slowing, enormous debt loads. It's a new political regime that refuses to work with the ECB to cut costs, which is necessary in order for you to get a bailout. And if you don't get a bailout, what's going to happen? Because you have extremists in there right now, and it's crazy. So we read a lot about Italy. How important is it? We read a lot about Greece. It turned out that wasn't a really big deal. Brexit, we got past that. Turkey, we got past that, right? And you can say, well, we didn't get past it yet, and you may be right. But Italy's a different animal. They're the largest economy in Europe. Not looking for a bailout. Political side, extremists now, which is, hey, let's do for the people. Let's just, what you're supposed to do. But when people just don't do anything, we don't need a bailout. You need to do something. You need to do something. You have to work with it if you want to get money. If you don't, man, these same people haven't lived through environments or studied enough to see what happens when things go terrible. That's why I want to bring Lenore on to give you the story, exactly what's going on, boots on the ground perspective of someone who has decades of experience covering things like this. And later on, I'm going to break down some really cool things and not so cool things that I saw at the Silver and Gold Summit in San Francisco. It's going to be for my educational segment. I talked about some of the meetings with top executives and even some of the companies that I visited that I really look attractive right now, with gold and silver completely out of favor. Before I get to that, my educational segment, let's go straight to Italy. Lenore Hawkins is right now. Give you this scoop on the economic landscape of this Eurozone problem child and how it could impact your portfolio. Lenore Hawkins, thanks so much for joining us again on the podcast.
Thanks for having me. Always such a pleasure.
I know. It's always such a pleasure for me too. But it's funny because we just spoke 5 minutes before this and you are in Italy. Yes. And I love getting boots on the ground information, and because it's so much different from what you read in the papers here. And I realized that when I went to Olympics in Brazil, I thought there was going to be body parts all over. I thought I was going to get killed. And it was one of the most beautiful places that I've seen. And sometimes what you read here is different from what you see there. But before we get to everything, I want to make sure that you're okay, because you told me yesterday there happened to be a big storm, right?
Yeah, it's been crazy here. We had, so not only has the city I'm in, Genova, is currently famous for having a massive bridge collapse that is a major artery for all of the European Union for things coming into a big port here. Like Genova's got one of the oldest ports in the world, to getting in from a port going into the European Union via rail and truck. And we had this huge bridge collapse that's caused a big problem. But now we've just had this insane storm where we had a landslide on the road going out to Portofino. So the only way to get in and out of Portofino is by boat. We've got a beach down the street from me that is covered with boats that were slammed into the shore. And all of this is happening at a time where Italian politics are about as messy as that beach.
I know. And Stacey, I didn't even know it was that bad. You were telling me boats washed up and windows blew out. So thank you so much for doing this, and safety, just stay safe. Hopefully everything's okay. But okay, let's get back to Italy. So we're looking at Italy, where we're reading the headlines here. We're seeing all this crazy stuff. Where could this filter over to the rest of the economy? There's not going to be a bailout coming this time. You've seen the 10-year go higher. Give us a story of what's really going on there, even from the political landscape.
Well, I think when you look across how investors are looking in the world, I think the biggest single thing that investors are mispricing is political risk. So like you said, there is no bailout coming. Italy just went to Brussels, and as is required in the European Union, they delivered their budget. And Brussels said, yeah, I don't think so. Send it back and said, you guys go back, try again. They've got until November 13th to give a revised budget. Just this, and that happened a couple weeks ago. Just this week, we heard that Italy's GDP in the third quarter was expected to grow by 0.2%. It actually grew by 0.02. So, I mean, that's nothing. It's stalling. It's not growing at all. So it grew at 0.02%, and that budget that they brought to Brussels? Well, it's anticipating a 1.9% GDP. Now, if you can't get that 1.9% GDP growth, which they are forecasting, that makes that budget deficit a whole lot worse. So this did not help them at all. But what's Brussels going to do? Because Italy is the problem with Italy versus Greece. Italy is way too big to save, and it is a much bigger mess than Greece. Now, Greece could keep pushing the envelope, because it wasn't too bad for Germany to cut a bit of a check and to help Greece get going because it was pretty small. Italy's now looking at Greece's playbook and saying, okay, we can push it. And to be fair, Italy is the only country in the European Union where the per capita GDP has actually fallen since it joined the unified currency. So this is a country where there's a lot of frustration.
So a lot of interesting points there. And one thing I want to get to is, for me, for someone outside, and you look and you say, wow, the ECB, they're not going to come together, not going to bail them out. And you say, well, why would you be in the euro for? But when you look under the hood, it's in order for them to bail you out, ECB, is you have to come up with a plan that cuts costs dramatically, and it's usually painful. And since Italy doesn't want to do that, so I think a lot of people, even when you read the headlines here, it's like, wow, why is the ECB, why are they not bailing them out? It's really like Italy, right? I mean, they just don't want to cut costs. So what's the solution here? What could happen? I mean, is this another? We thought it was a great idea. Remember during the credit crisis, we were like, wow, let Lehman fail. And then we're high-fiving each other and the market went up. And then we realized, holy, look at all the massive amount of risk, how everything's connected. Is this something that the central banks see? Because Italy probably doesn't see it themselves, but is it maybe Italy does see it and say, hey, you're going to have to bail us out anyway, because if you don't, it's going to hurt everybody in the euro. I mean, how is that playing out, that whole scenario? Because there's so many moving parts.
Yeah, there are so many moving parts. Well, first off, the Italian leadership it's a group of jokers. I mean, I hate to say it because I love this country dearly, but the guys who got in don't have a clue what they're doing. And they are two groups. The coalition government, think of it as a guy who's way far left of Bernie Sanders teamed up with a guy who's way far right of Trump. Imagine how effective that coalition is going to be. It's just not going to work. Now, on top of that, you've got where Angela Merkel, her Christian Democrat Union, they have suffered serious defeats at the polls over the past month. And she's just announced that not only she's stepping down from the CDU leadership, a post that she's held for 15 years, and she's not going to seek re-election in 2021. That was the last really strong European leader. So Europe's kind of a mess. There's no strong leadership. There's no one who can really solve the problem as we head into this crisis. On top of that, you've got Brexit. It is not going well at all. When May came to the European Union and said, here's my plan for Brexit, they pretty much said, you got to be kidding me. We're not terribly disrespectful or terribly respectful. There's a lot of acrimony there going back and forth. So that relationship's not going very well. And that is going to be weakening as well. But nobody's really looking at that. Now, the big thing with all of this is, how do you price assets, right? And where are asset prices going? Well, the way you price assets is really based on risk. And the way you look at that is, well, what's the risk-free rate, right? So if you look at yields right now, because that kind of sovereign yields, that's kind of the idea behind the risk-free rate. Right now, the US 2-year is yielding 2.8%, 2.8, like 5%. Italy, 1.13. It's less than half. So Italy is less than half the risk. Germany's 2-year is a negative. You've actually got about a 3.5% spread between the German yield and the US yield. I mean, that 2-year yield, that makes absolutely no sense. Now, if you've got nonsensical yields, Germany having a negative yield, what does that mean for asset prices when you're pricing off of the risk-free rate? That just perverts price discovery across the board. And we're starting to see where investors are realizing that. And one of the things that's really going to push that is, in Europe, the European Central Bank just reaffirmed that they are going to stop their asset purchases. Well, the European Central Bank has been the only entity buying Italian bonds. those Italian sovereign bonds. And Italy, given that they're going to be running a deficit, because for a while there, people didn't really care so much about Italy's massive 130% debt to GDP because they were running a budget surplus, right? So they weren't having to go out there and get more. So it was kind of treading water. It was all right. Well, now we're looking at a very different shift. We've got about 200 billion of Italian debt is going to come due in 2019. And given the deficit, at the minimum, it looks like they're going to need an additional 60 billion thanks to a budget deficit. So that's 260 billion that's new that they're going to have to get out there. And the biggest buyer, the only buyer of Italian debt, is going to be stepping out of the market at the end of the year.
Pretty amazing numbers there. And I mean, even the things that stick out to me is one of the numbers that I'm reading is, I mean, it was funny because last year, I think it was only $20 billion, I think, was a bailout. And the market saw that as a great thing, right? I mean, we saw the 10 years stay low in Italy, around 2%. All of a sudden, it shot up to 3.5%. And just to put this in perspective, I mean, it's the highest level since 2000 and probably about 2016, into 2017. But it was a lot higher even before that, 2014, 13. I guess my question to you is, when I'm looking at debt to GDP ratio, which it seems like 130%, when I look at everything underlying and I'm looking at the total package, we're looking at, I think, and I'd love to get your numbers. Is it 3 trillion? Is it more than that? Is it less than that? And again, I'm getting my sources from other sources and things I read, which, are pretty good source, I think. But it seems like this, what is going to happen? Like, what's the solution? Is that the right amount? Because, you're looking at, they're probably paying the highest interest out of almost anyone in Euro, the major countries, at least, they're largest. So, how does that whole play out? Like, because as it gets worse and these rates go up, it's terrible.
It is. And Italy just is not in a position where it can withstand that kind of a pain, because like I said, the per capita GDP has been falling since it joined the European Union. So you've got political leaders in Italy who don't have, they want to stay in power, and they don't have a whole lot of support for putting more pain on the citizens. You've got Germany saying, well, the problem is you guys just need to take more pain. That's not a conversation that's going well. And now you've got really no strong European leadership when chaos is starting to reign. So my bet, looking at it all, is that there's a very good chance that Italy is going to step out of the European Union. It has not done well for them. What has worked for them has been their ability to get debt really cheap, right? They're paying artificially low interest rates. If you look, for example, Italian bonds this month were just downgraded. The sovereign bonds were downgraded to just one step above junk by Moody's, and they were downgraded just 2 notches above junk by S&P. Yet Italy's 5-year is at 2.5%. If you look at what the ETF J&K is yielding, that's 6.3%. That spread makes no sense. So what happens if the market starts getting really nervous? Italy and the Eurozone are not getting along. And you've got the people in charge in Italy are people who want out of the Eurozone. They have publicly, well before they were elected, said that they really wanted out. There have been Eurosceptics from the get-go. And if the Italian people look around and go, what else are we going to do? We need to default on our debt. We need to get our own currency. We need to get the hell out and start it all over again. I think at some point, particularly if we see a global downturn, which will hurt, it hurts the weakest first and it hurts them the most. Italy is already almost in contraction. If we do see global slowing increase further, which right now, we're seeing China slowing. We're seeing signs that the U.S. is slowing. We're seeing the Eurozone GDP is at the lowest it's been growth rate since 2014. If that all continues, Italians are going to say, well, it can't get worse. And if that happens, let's just look at what yields are going to do across the world.
Now, I have a very interesting question for you. Now and I love thinking like this because it's just taking the other side. And I know that could be absolutely crazy for everyone that's listening to this. But did you ever take a step back and say, hey, is all of this factored in? And the only reason why I say it is because with our credit crisis, what happened? It was the unknown, right? We didn't know that AIG was insuring all this garbage, and we didn't. I mean, it wasn't subprime. It wasn't subprime that caused the crisis, right? It was the synthetic loans. It was the leveraging of subprime. It was synthetic CDOs that were off balance sheets of the banks. Nobody knew. AIG was insuring this whole thing. I mean, the Fed didn't know until like mid 2008. Until the crisis happened. But everything that you say is, and everything that we see right now, right? Okay, we know they want to exit, right, the euro. We know that we saw the same thing with Greece, Turkey, Brexit, right? All these things were supposed to crush it, and it seems like we weathered the storm today. You look at GDP, like you said, it's horrible, but it's still a little positive. And then when I look at rates, yes, on a 10-year, we're wherever 3.4, 3.5, but they're still lower than they were in pre-2014. I'm not saying I agree with this, but I'm just asking you that question because I always look when I'm so like, wow, this is crazy. I try to look at the other side. Is there any way that this is factored in, or maybe there's a better solution where Italy might not be a problem 3 years from now? Or is it like absolutely no way? You just don't see a solution?
Well, great comparison to the financial crisis. Because if you look at what happened with the financial crisis, one of the core mistakes there was mispricing of risk. Right? Because when people were looking at these subprime mortgages, how risky they really were, so what yield that they warranted was not being priced correctly. The risk across the board was not being priced correctly. And we have the famous Bernanke, the problems in subprime have been contained. That didn't turn out so well. I see here a very similar thing where the political risk is being seriously mispriced because we're in an era in which everyone believes that central bankers can fix it, that central bankers can take care of it, or that the political leadership is going to get it all sorted out and it's going to be fine. And there's a good reason to believe that because since the financial crisis, every time we had, things get a little wobbly, those central bankers stepped in and sure enough, they put a floor under asset prices and kept boosting stuff up. So if anyone looked at this and said, oh, this is bad, this is really, really bad, I'm concerned about the fundamentals, you got killed. So it was very much, we have been trained over the past 10 years by the dip because it's never going to come down, not in any real way. So I think your comparison is there in that people believe it's going to get fixed. It's all going to be fine. It's all going to get worked out in the end. And I don't think that's going to be the case.
No, that is interesting. And it's amazing because one of the worst things that happened during the credit crisis, I think, and it's me talking personally, is that everybody that they bailed out, they made a fortune on, right? Just about AIG, all the banks that they invested in, the housing market came back so fast they don't even know what to do with Fannie and Freddie. It's making so much money, profits, and it makes it, and that opens the door. Well, okay, they'll be all right. If it comes down, if the market comes down, even in our market. Not that I'm asking for a solution here, but is it, hey, avoid everything Italy related at all costs? I mean, because what private equity firms do, which individual investors, most of us don't have access to things like that. But when you saw during the just European credit crisis, which was a couple of years kind of after us, the banks were forced to sell off like assets at dirt cheap prices, and you had private equity guys going in there and buying stuff, and now they're making a fortune off of it. Is there opportunity at all? Is it just, hey, we have to avoid it because the political landscape's so bad and you have no idea what's going to go on? I mean, again, someone from the boots on the ground and probably talking to people and companies and things like that. I mean, is it just avoid Italy right now until there's a clearer picture?
I think you definitely want to avoid Italy on the long side. I mean, one of the challenges you were asking about, what's the magnitude of that number? Like, how bad is the debt situation? Well, one of the dirty little secrets that you only know if you actually are boots on the ground and dealing with entities that deal with the government here is that the debt situation in Italy is actually, for the sovereign debt, is actually far worse than you would believe. And it has a crippling effect on the economy in that the portion of the economy in Italy that is government spending fluctuates right around 50%. So 50% of the economy is actually just the government spending. The problem is when the government spends, that means it's hiring somebody to do something. So hiring a construction company to build, say, a bridge, to go with something fairly topical. The problem is they don't tend to pay. So one of the biggest problems you have throughout all of Italy is that these companies that the government hires to do stuff, the government then doesn't pay them. And that just grinds this economy down slower and slower into a halt, because if the company's not getting paid, how do they pay their employees? How do they invest in their own productive capacity? How does the economy grow when the 50% of the economy that is the government spending often is paying things a year plus late? And that isn't being accounted for in the GDP. They're playing little accounting gimmicks where they're not putting it into the total debt. They're like, oh, it's short term, so it doesn't really count, right? It's a payable. We're just haven't cut the check yet. Yeah, you haven't cut the check for like a year and a half. So it is actually a far more challenging situation. Now, as far as what can an investor do, I think one of the things that people can look at is, well, what are the floors and the caps here? So you look at Italian debt. And with Italy it's on credit watch. They were given a negative outlook by S&P. You've got them just shy of junk rating by Moody's, and yet the Italian sovereign yields are tiny compared to what junk, would a high yield bonds in the US would be yielding. And at the same time, you've got Germany, where we're in the middle of all this political turmoil, and Germany's got negative yielding 2 and 5 years. So I think an interesting way to look at this would be, what if you were to go, say, long the US Treasury and you were to go short German? Because Germany, you go short a 2 or a 5 on Germany, and that's actually paying you because they've got negative yields. So you're actually getting paid to carry that. Yep. And on the other side with the US, you're getting a 5. If you go with the 5 year, you're getting a 2.9% yield. So you're actually getting a pretty solid yield out of that. We're just sitting there, and I don't see German yields being able to go a whole lot lower than they are right now, particularly given what we are going to see, the fireworks that are going to be coming up, I think, in 2009. I mean, you've even got people in Germany, in Brussels, many of the leadership saying 2019 is going to be a pivotal year for the Eurozone. It is going to be the make or break, because it is across many countries. You've got it in Spain as well. You've got, with Brexit going on, there's a bit of an existential crisis in Europe, and people are questioning, is it really worth it to us to be in it?
I think you just came up with an economic trading newsletter. That would be fantastic. I'm serious. You don't hear about, right? Just, nope. Trades within no, it's fantastic. So listen, okay. So we got the scoop on Italy. Awesome. Amazing stuff. Now I want to talk about the US, because now we're seeing, just coming off October, where the market's coming down. Again, it's going to be, produced or published later on. So, this is almost as real time. So, but, almost through October, and you're looking at our market, starting to rebound a tiny bit. We're looking at valuations. We're not super expensive, but we're out there saying, wow, the economy's fine. We're okay. And even housing, where you're seeing, headlines like the market's coming down. It's more like a supply problem. There's just no houses on the market, right? And you're seeing interest rates, yes, go higher, and that's going to, hurt, mortgages and new origination, things like that. But when you look at the housing market, it's not like, say, uranium, where they're cutting supply off the market and there's not enough demand. There's tons of demands for houses. They just can't build them fast enough. So people are even saying, well, the housing market's not as bad. And you're looking at our GDP, growth that just came out, 3%. So what are your thoughts about the U.S. economy? I mean, is it strong? And let's not look at the stock market and see is that the indication, because we just went down. But what are you seeing in the underlying things within the economy maybe that other people aren't seeing?
Well, I think one of the things that nobody was really looking at, I haven't heard anybody talking about it, is if you look at the 5 Federal Reserve regions, that's like the Dallas Fed, Empire State. There's 5 regions across the country, and they report monthly on what's going on in the manufacturing sector and what's going on in the service sector. And if you look at the recent reports out of them, basically all the, I think it's like 13 categories, all of them are down year over year, with the one exception of the 2 categories for pricing. Prices received and prices paid have gone up. Everything else has been going down. So I'm looking at that and saying, well, how is the economy going all gangbusters if I'm looking at that? If the economy is doing so fantastic, why is it that we're running the biggest fiscal deficit on record outside of a recession or a war? That seems a little strange to me. And if you look at the third quarter GDP and the second quarter GDP, those numbers were really perverted by some pull forwards and based on what's going on with the trade war. That like third quarter, you had a big buildup in inventory in the U.S. because companies are afraid of their costs going up because of all these tariffs going on. The recent Fed Beige book was full of executives complaining about how they're facing some serious price pressures because of these tariffs. And while we've got, I think it's about 49% of the S&P 500 companies have reported, what we're seeing fairly consistently is while they made earnings, they were struggling a bit with revenues. But the big thing is of those that provided guidance, 63% have reported negative guidance because they're looking out there saying, ugh, this is getting a bit tougher. You've got a dollar that's getting stronger. You've got the China economy weakening. It's getting weaker and weaker. You're seeing Europe at the slowest growth rate since 2014. How long can the U.S. continue to say, we're going strong, when all that's happening? And when a good portion of our growth has really been attributable to fiscal deficits. And those fiscal deficits can't continue to go on. And it's particularly unlikely to go on with what may happen in the midterm elections. Normally, when you have, a presidential election come in and the one party sweeps, say the House, Senate, and the presidency, in the midterm, you normally see a flip-flop of that. It's possible we won't see that. Historically, that would be a very unusual thing to do. And so far, the polls are indicating that the Democrats will probably gain a lot. If that happens, if we get a lot more Democrats in Congress, they're probably going to be going up against Trump. And it's going to be a lot harder for Trump to get through the spending that he wants, which means that deficit spending and all of that government spending that's been helping to kind of jack up the GDP, that's not going to be there. And don't forget, we still have a Fed that's in a rate hike cycle, and that's raising costs. So for businesses, they're seeing tariffs are affecting their input costs. We've got rising wage pressure, unemployment at just an unbelievably low levels. And that unemployment is also affecting productivity because, for example, over the past 4 months, 100% of net job growth has gone to folks with a high school education or less. Now, those are not the most productive, right? So if they're not that productive, it means companies are having to pay for less and less productivity, and add to that a rising dollar, which means those companies who generate revenue overseas, that's facing a headwind.
Yeah, there's so many uncertainties, right? I was surprised that that number of companies, just lowering their guidance wasn't higher, right? Because like you said, even interest rates are uncertain right now, right? We have, the president saying one thing, but the Fed saying another, but it's, that, which is, kind of normal when you look back in history. But just the dollar, China, the midterm elections. I mean, there's just so many things. Like you said, we talked about this whole podcast, Euro, it's very difficult to forecast. Doesn't mean they're not going to make estimates, but if you're running a company right now and you're looking at this, it's hard to be optimistic and raise your estimates in the face of so many question marks, I would think. But I guess let's finish with this because I can really talk to you for another 2 hours. I know how busy you are because this conversation is going great. So, it's usually not scripted. We're like, all right, we're talking about Italy, U.S., and I just love getting your thoughts. But I have to bring this up because your partner in crime, Chris Versace, who's on this podcast, who I love very much. But I'm actually going to make the case where I think I know who has, who really the brains behind the operation, because the last time you came out, I'm saying that because I love Chris and he's a great analyst and he's awesome. I know him for a long time, working with him at Street. But last time you came on, I tried to get a stock pick from my guests because I realized so many of my guests mentioned so many great names and they weren't taking advantage. So I said, let me create a portfolio. This way you guys could see this and help you make money. You said, hey, I have one stock for you. It was Universal Display, OLED. It's maybe one of the only stocks it's 6-month high. I mean, it's probably you'll find, but it's a stock that just went up tremendously after you talked about it. And now that makes you the best stock picker at the company more than Chris. So I want to get, I'm going to get an email about this later. But
you're completely, he's gonna harass me pretty good over this.
Oh, this is great, and I have to tell you, yeah, it's great because and he has so many great things to say about you. He's so funny because anyway, but what is another stock, maybe something else that you're looking at? Because I know that you, Chris, talk. I know Chris is really, you're more the economy and economics and global, and he's more stocks. But both of you talk about it. What is some of the things that you guys are looking at, or something else that could be attractive for investors right here?
Well, right in the mid, right, like more in the short run, I'm a little bit more interested in playing with the yields, because I think, like what I was talking about with Germany and Italy, because I think in the near term, if people are looking over the next couple of months, I think the overall stock market picture is going to it's going to remain pretty wobbly. So I'm not confident in anything just because it won't matter. Everything's just going to get swept up. But looking at kind of the bigger picture, one of the companies that I think is going to be a really fantastic buy, if be patient, is Amazon. Amazon is just making more and more ground into so many of our investing themes. For example, with the baby boomers, Amazon's doing more and more things with getting into the home, with healthcare that's going to appeal to that demographic, and the demands of that demographic for healthcare, for technology that helps with assisted living. That's only going to grow. I mean, there's Amazon hits on almost every one of our investing themes, and it's getting hit pretty hard. They gave not so fantastic guidance, which is kind of par for the course for Amazon. Out of the last quarter, they're down about 25% from their high, which for me, it's like, oh yes, great time to start looking at getting in. I think it's going to be a bit more wobbly though. I wouldn't be in any huge hurry to hop in the next couple of weeks, because I think we're in for a few more fireworks. But I think that is one of those ones that you can hold on to, be patient. We're going to get some great opportunities, and that will be one that is going to be a hold on to it for a very long time.
Yeah, it is. You're looking just at younger generation, whether it's smart homes now that they have Alexa. I mean, everything's going to be smart homes, whether you like it or not. You're looking at cloud, of course, baby boomers, healthcare, like you said, Whole Foods, and they're the best play on U.S. consumer spending, which, let's face it, is the greatest secular trend in the history of the markets, right? Because we've said it probably, you've been doing this for longer than 20 years. I've been doing this for 25 years. The consumer spending is going to, it never slows, right? Maybe for a small period, but it just never ever slows. And these guys, right there to benefit. So, Tematica Research, what are you guys doing? If someone wants to find more information out, because you guys are doing some really great things, and I mean that. I don't want to say that about everybody. I love the research you put out. I know you both of you are active at Twitter. If someone wants to learn more about you and just read, where could they go? Give them everything.
Yeah, come check us out at tematicaresearch.com. That's TEMATICA research.com. There you can find links for all of our stuff, everything that we write, links for where we are on Twitter. Chris and I tend to publish a lot on there as well, just our latest thoughts on what's going on in the world. And we do also publish, one of the things I think is fun for us is our signals, where we look out and say, well, in the news, just in the news today, here's what we're seeing is going on, and here's how that applies to our long-term investing signals, and what investors can do to turn that into something to make money with.
That's great. And Laura, listen, thank you so much for coming on. I know we're doing this from Italy, and be safe, because I know that you told me if we did this yesterday, it would have been trouble. But just be safe, and I really appreciate you coming on and how busy you are.
Thanks a lot, Frank.
Wow, great stuff from Lenore. And truly one of the best economists I know. And I mean that. I've interviewed a lot of economists. I know a lot of economists. Because what I realize with economists, I'm not putting anyone down here. I'm just saying from my experience doing this for 20, 25 years, I've spoken to I wouldn't even say dozens, but hundreds of economists. It's more than just studying numbers. I mean, you look at economy and bell curves and looking at what happened over the past few years or past decades and how that can relate to the future. And, it's such a numbers game. There's so many numbers involved, right? I just find it kind of weird that we don't update our systems with new algorithms and everything, that we still have to go back with some of these gauges and revise them 3 or 4 times after they report every quarter. And just how we calculate things, almost like the same way, like inflation. I mean, is there a better gauge in CPI when we know all the costs are going up? But, well, let's exclude, food and energy, which they're not excluded from us. Those are some of the highest costs. So you need to know more than the numbers when it comes to the economy. Because what's the economy about? The economy is about you. It's about me. It's about spending. It's about sentiment. So you need to get out there. You need to understand people. Because that's what we want to know when we look at economists is we want to know what's going to happen in the future. And they're great at telling us what happened in the past and what could happen. But things don't always follow them. So history repeats itself. That we never had a bailout like we had. I mean, it's a whole new market of understanding. We never had super low interest rates this long before, even though they've been raised, 6 times. There's different things. You go out on the street, you talk to people, consumer spending, what are they spending on? Are they saving more? And we used to take all of our money out of our homes and spend it. Now there's $7 trillion in our homes that people aren't spending right now. Things do change. Yes, history does repeat itself. We see it, but it's not exactly. I mean, conditions are different. You can't say, well, the market's trading at 16 times forward earnings right now, which is true. And then, that if you look back last time, 40 years ago, it was trading at 15 times earnings and all this stuff. But you got to go back and look at where interest rates were. They weren't at zero. You didn't have better tax reform, right? All these tax reforms, which are, you can say, artificially inflating earnings even more. So you got to look at all the conditions, and then you have to look at how they spending. Knowing people in the industry, like everyone say, well, look at companies and how much they warned. Like, we talked about that. It's true how much they warned. What do you expect? I mean, there's so many risks out there. You got to be crazy to be super optimistic. You want to be conservative. It makes sense to be conservative. Say, hey, you know what? Maybe it might be in a low end of our guidance and high end of guidance. That kind of counts as a warning. And you say, well, 40% of the companies warned for next quarter. Well, they're just, they're conservative and don't know what's going on. But I can tell you, if we, change policy on interest rates or just the language around it, I mean, that's going to change dramatically, right? Yeah, that's a big. Or if we solve this, China comes together with the U.S. and just solves their problems and gets along. That's a game changer. Now, instead of the low end, it's going to be the high end. And maybe if those problems didn't exist, they would have raised guidance into next quarter, which gives you an opportunity to buy. I don't know. Getting back to Lenore, I love the fact that she's in tune. She's out there. The boots on the ground, and she's talking to people. Yeah, that's so important as an economist. And sometimes, economists are just built where, I got to look at numbers and maybe they're not too great social skills, which is fine. And they're brilliant people. Some people, at least, a lot that I met, I'm again, just not putting anybody down or whatever. Everyone's like special within their own self and how brilliant they are. And, I'm not sugarcoating, but there are great economists. But it's important because, looking at the economy, trying to predict the future, you need to understand people and sentiment. And Lenore's really, really good at that. I love it. So I love talking to her. She always got a great perspective, never sugarcoats anything. Again, this podcast is about you, not about me. Let me know what you thought. FrankCurzioResearch.com. That's Frank at CurzioResearch.com. And just one more shout out to Laura for coming on. I couldn't believe she underplayed how bad that storm was. I had no idea. She's like, boats are everywhere. It's pretty crazy. And she still did this interview anyway. So I really, really appreciate it, especially getting that boots on the ground approach from all the way in Italy. Now, let's get to my educational segment. Came back from San Francisco. Silver and Gold Summit. Wanted to give you a quick update of some of the things that I saw. So I talked to everybody there. I speak Doug Casey, Rob McEwen, Rick Rule. I mean, some of the things I learned is, one, it wasn't heavily attended, which is usually a good sign. People really don't care about gold and silver right now, right? When they can make 15% on Amazon every single month. Well, maybe not last month, but every month, probably like 3 years before that. But you're seeing rotation. You're seeing more people talk about, hey, we're putting more money into gold funds. Are they looking to do it? But they're not doing it yet, because one thing I realized, which is kind of amazing, I didn't know this, and the short positions on gold and silver stocks are probably at the highest levels that I've seen since 2009-10. The guys are telling me that the short ratios on these stocks, which, again, in Canada, it could be a little different, but a lot of these companies and the ones that I talk to trade on big exchanges in the U.S. Just look at some of the short positions on it, which is good for you, right? Because if things go bad, look at Tesla, right? Elon Musk's going to come out, he's going to say whatever he wants to say with the numbers, and things are clearly good. And once you do that and the shorts cover, look what happens to the stock going from 250, wherever it is, 330, wherever it is today. So if you see any good news come out of these things, and I have to tell you, when you're looking at producers and gold and silver producers, guys like First Majestic Silver, which I talked to Keith Neumeyer, Robert Ewing, gold. The short positions on their stocks, trading the exchange, New York Stock Exchange, are enormous. And they're reporting great results. They're reporting really great results. And still, the short positions are enormous. If there's a change in sentiment, you're going to see people fly to the exits. And even, you don't have to buy juniors. But mid-tier and top-tier producers like Newmont has come down too. You know, I love Newmont. I think it's a great company. I think they separate. I think Goldcorp bombed that quarter. That was different. But all these guys, if you look on the gold, the producing side, they're all producing for less than $1,000 an ounce right now. And we're over 1,200. Which is important because gold prices haven't really come down, right? They haven't really come down that much over the past, 3-4 years. Yeah, they're down from their highs of 2012, but it's been kind of stable, which is weird because every company, even some of the majors, down 60% plus in this industry. And that matters a lot. If you're producing, you're making money and things like that. But if you're not producing, still, you think you would get killed because of that? I can see if the underlying commodity, which your whole business is based on, crash, that's different, like uranium. It's not the case with gold. It's just out of favor. And what I realize is you have to talk about, which is interesting, because Rick Rule is creating a digital security, and I don't know if so much if it's a token, again, but it's fascinating, that will allow you to store gold digitally, right? So it's just making it more exciting, making it more fun. But yeah, I think gold investors and the gold bugs are just a store of value thing. I mean, the new generation, no one's talking about storing value. The people who store value, those are the people who own gold, right? It's not going to drive prices higher. It's fundamentals, which look incredible right now because there's been hardly any major discoveries. But if you look at, which Rob McEwen told me about, great meetings, some of the companies pointed out like 4 or 5, I won't give them away because I want to look at these companies and I recommend them. But there was 5 companies he highlighted that made big discoveries recently. All 5 of those stocks are up tremendously. So you're seeing separation in the industry, which is good. It makes it more of a stock picker's market, people who do the due diligence and boots on the ground and look at this stuff. It's not just the whole industry. But the fundamentals are lined up. The short positions are really high, which is good from a contrarian point of view, because they cover, that's where you get the big gains of this. But if we see any bit of this cycle turning, which we may, and my thesis is, look, a lot of leverage coming out of the market, people making so much money. Remember, funds only make money if they put that money to work. So they're not going to take it out and put it in cash and say, hey, that's cool. It's going to be rotating, and that's what you're seeing, rotating. Utilities doing okay. Consumer staples are doing okay. More safe havens. You're going to see money pouring into uranium. Again, that's not exciting, but people saying, hey, I know 3 years just make prices are up. Prices are up tremendously, 30, 40% off their lows. Got to go up a lot higher, but with massive cuts in production in that industry, massive, and demand coming online. It's no longer China's going to see 30. No, plants are coming online now. Mike Alkin's the best at this. He'll tell you. Try to get buy information from the uranium sector. But Rob McEwen, I mean, you're looking at that company, they can produce under 1,000 an ounce, maybe a tiny bit above that. Great projects coming online. You look at a guy that his salary is huge, though. It's huge. He makes $1 a year. No options, no nothing. And owns, I think, 28% of his stock. What do you think his focus is on? He's looking long term. All his money's based on that stock price. Where is it going? He thinks it's going a lot higher. Obviously, he's put his money where his mouth is. Look at companies like that. First Majestic Silver, that was attractive. Uranium Energy, just did a financing. It got crushed after the financing because in October, everything got crushed. It was trading at a pretty good price. It's incredible how much that company has come down. These are some of the ideas that I saw at this conference, just talking to people. I mean, the sentiment is completely out of favor, more than ever. In the past years where you still have people that are bullish, no, it looks good now. It looks good now. It's kind of like the CEOs are like, oh, man, I have no idea, which is good. That's what you want to see when you invest in an industry like this. Nevada exploration, Dennis Higgs was there. It was a highly attended event. I think it was a morning where we hosted a morning breakfast. Huge demand. That stock's up tremendous for our subscribers, who got into that private placement. And I had him on a while ago. I mean, it's funny because he doesn't do a lot of speech. He's like, what am I going to talk about? I said, why don't you talk about that? Maybe the only gold stock that's up a ton over the past 5 months. I said, you should have nothing to worry about what you talk about, because he's just like a humble guy and really cool. And I had a great time with him. One of the guys that went out for drinks with us. And also Northern Dynasty. Northern Dynasty is a company I followed for a while. We went there. We went to Alaska, saw that project. All political. There's no streams that go through their property. even though they say those streams, they're going to get damaged and sockeye salmon, they're in trouble, whatever. It's a complete joke. But there is, if you're looking at these elections, it's going to be more politically favorable, right? The person who's leading right now for Alaska, very, very good for the companies in favor of this and mining, right, for the political landscape compared to now. And you want to look at the price of the stock, right? Where's the price of stock trading? It's trading at levels where we first went there. It's incredible. I mean, it looks like you should be buying this thing at 2, 3 with so many news underwriters are recommending this thing. We were like, I say me, with Mara and I went with one of the best geologists in the world, Doug Casey, went with a whole bunch of people, great crew there. We saw this thing and said, wow, this is amazing. I went to 250, 270 people recommend this thing. I'm like, you're crazy. For me, I looked at it and said, it shouldn't be trading at 40 cents. Even now, I don't think it should be trading at these levels, which is dirt cheap. I mean, all that risk is really factored in. And yet you have most likely, very, very likely, in a couple of weeks, that political environment is going to change for that area. I mean, more pro-mining friendly, which is, that's a big part of Alaska, the election and things like that. Again, all you need when you see everything complete, I'm not saying it's going to get developed or it's going to take a long time, whatever. What I'm saying is it's pushed to the price where everything is factored in, all the negatives are factored in. And when you're beat up that bad, you just need one small positive, a little thing like that, which no one's talking about that election, and that thing could easily double from here. And that's how I was looking at it when I went there. I didn't think I'd buy Northern Dynasty. It was incredible. Another great thing is on Monday, I had my speech and I did it on a security token offering, and demand is just incredible. I mean, people asking about it, and not just individual investors, but a lot of institutions have come up to me. Very exciting. What can I do for you? This sounds so great. This is amazing. What structure? What are you doing? Again, this is going to come out a month from now. If you're interested, frankcurzioresearch.com. You have to be a credit investor to invest in it. I talked about it the past couple of weeks. Again, this is investing in our company where you're going to get an equity stake. Okay, this is something that you're backing me. It's not, I'm pushing a product or whatever or things like that. This is, we're revolving our whole company around it. And I told everybody, the last thing I told them, I said, look, this is one of the greatest industries I've seen from someone who's covered so many trends all over the world for the past 25 years. I think this trend's going to be bigger than anything that I've covered. And I said, if you don't believe me, I'm basing my whole company on it and my reputation on it. I said, could I be wrong? Absolutely, because we're going to be one of the first to the market, or the first with a security token. You're going to get an equity stake, a dividend in an existing company, right? It's not like, hey, this is what we're going to do, and we didn't even form the company. We don't even have a headquarters yet. When you're first ever, it's scary. And I told everybody, could I go down in flames? Absolutely. Yes, it could. I'm not going to lie here. There are risks. Of course there are risks. But I also said, if I'm right, this is a really good opportunity for investors. And it's not an opportunity that's going to make you a little bit of money, but it has the opportunity to make you life-changing money. That's how much I believe in this sector. And guys, the news coming out is incredible. And you have one of the biggest executive producers out there, person who produced Birdman, which won Oscars, is launching an STO token. This way, people could finance movies. Individual investors could finance movies. Do you think that would ever happen? St. Regis Hotel, Aspen, just sold off a portion, security token. This way you could own, any asset could be tokenized. It gives individual investors that chance to invest at what is a Babe Ruth rookie card or valuable art or real estate or even companies. This is a game changer for me. I really believe this industry is going to be incredible, and just overwhelmed by how excited everybody was and the questions that they were asking, and how not too many people, very few people know about this industry. No one's really talking about it, because it's like merging the young generation with the old generation, and you have to merge those together, which requires a lot of education. And I feel like we're ahead of the curve on that. So it's something I'm very excited about. Really awesome. Again, if you're a credit investor, you're interested in learning more about this, frankcurzioresearch.com. I can only offer it to credit investors because there's very little regulation on it, which is going to come out over the next 6 months. You see the first, right now, the very first STO exchange is going to be launched this month, and you have a whole bunch coming in. NASDAQ's on the side, ready to launch a STO exchange. T0 last month. And we went from an ICO exchange to launching an STO exchange, and last month they just have their token, a security token, which is like a preferred token. But just the interest I'm seeing from people who know nothing about this industry saying, wow, this tokenization, I would love to do this for my company or my ideas. And half of that money going into an STO fund that we're going to build through this to invest in these ideas. I think that's really the $1 billion idea. And that's why I'm so excited. Again, there's lots of risks. If you want more information, frankcurzioresearch.com. If you're not a credit investor, it's okay. What that means is it's for the first year. Again, by law right now, for the first year, it's got to be credit investors. It's not even going to be trading. And when it does go free trading, anyone could buy it. And when you do buy that token, you're going to have an equity stake and you're going to get that dividend. But just right now, we have to do it because that's the way it is. And those are the laws that's what required. So again, frankcurzioresearch.com. If you have any interest in it, and we will be reporting and just, showing you some of the things that I'm seeing because of research, which is fascinating. Again, that movie token and so many platforms moving to this. Coinbase actually say we're going to trade security tokens now. So it's just a lot of fun things coming down. And I think you can see a lot of this industry grow tremendously. And a lot of great news come out, at least over the next 6 months and much, much longer. So, guys, that's it for me. Man, covered a lot today. I get plenty of questions on politics, which is fine. But I mean, that's the biggest risk. That's why I'm talking about it to investors right now. So pay close attention. Thanks so much for listening. I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.